Welcome, everyone. This is David Morgan of morganreport.com. I want to thank Metals Investors Forum, again, MIF, for inviting me to be one of their presenters in this most crucial time in the global economy. Thank you, Matt. Thank you, everyone involved with MIF. So let's get right to it. What I have on here is the way I look at the markets. Obviously, I'm more than a technician. I look at fundamentals. And the fundamentals about copper, it's referred to as Dr. Copper. And copper is purportedly a good way to get a handle on the overall economic situation on a global basis. And I adhere to that. I think oil is more important, but copper still plays a significant role. So you can see from this chart that copper was very much in an uptrend from, let's say 2020, bottom in March, April, and rocketed up, consolidated it with a high level consolidation, moved above the 50 and 200-day moving average, and now it has fallen out of bed. This is, to me, a key indicator that we have trouble. I don't want to be too gloomy or too doomy. I want to be as realistic as I can. The copper is signaling falling that fast, that far on average volume means we have problems, big problems. Now, gold, a very long-term view, and I just returned from the Las Vegas Money Show, which isn't oriented toward resources very much, but I was on a panel, and we did, of course, talk about gold. The thing about gold that I think is misunderstood, even by gold investors, is where are we in the gold market? And here is a long-term chart going back to 1988, and I'm going to dial in on this a few times for this presentation. And what I'm proposing is that the one key element that I think most of the gold bugs, gold newsletter writers, analysts are missing, I will show you. But first, I want to give you the big picture. So from the bottom at 252 all the way up to about 1900, gold was the best asset class year over year, almost every year for 11 years. Silver actually outperformed gold a few of those years, and it wasn't straight up. And this chart looks straight up, but if you were up here and bought it at 1,000 and watched it drop to 700, you would not be that happy, obviously. So that's point number one. But on aggregate, over the long term, huge move. Now, we are now here. So for the first 11 years, you couldn't do anything wrong. Gold stocks, just about anything went up. So then we had this massive consolidation, a big what we call U pattern. And basically, it took almost a decade to get back up to the original high, maybe a bit beyond it. And now we've done kind of what I would call a mini U. If we go from the beginning to the present day, gold has had a compounded annual growth rate of 10%. This is phenomenal. Over that same time frame, it has beat the S&P and it has beat the bond market. In other words, over that 20-year time frame, gold is superior to both of those investments that are highly touted by the mainstream financial pundits. However, and they hardly ever mention gold unless it's a down day, but I'm biased. I would say what we're looking at here is gold got ahead of itself. I don't like to say that, but you can't get 10 years further out and still have a 10 CAGR, compounded annual growth rate, without some phenomenal growth for those 11 years, and we did. So gold is now pretty much caught up to where it should be. And I say that because what we have is a breakout area right now. Consolidation is complete, and I think we're ready to move higher. So I want to dig into the gold chart a little deeper right in front of you. I'm doing this, real time, and I'm going to go back just 10 years. I'm going to update this chart. So we go back to 2008, which is right here. What I want to point out is what happened during that time frame. So let's take a quick look here. 2008, we had this fallback on gold. It went down to 700 from a peak of, I'll call it 1050. You can argue, but let's take the number. So what we have got is a fall of 300 plus. And it's easy math. Take 1,000, it's a 30% down move. So we had a 30% down move during the financial crisis. That is a number I want you to bear in mind, because now I am going to update the chart and show you where we are now. So I'm only going to look over the next 3 years. I'm going to update it, and I'm going to do the same annotation so that everyone can see what I'm doing and what my thinking is. And this should be your thinking as well. At least, well, let me restate that. This is the way I'm thinking about it. You can accept or reject it. So during this current financial conundrum that we are in, gold has gone from 2075 down to 1800. So we have had roughly a 200-point move down. And a 200-point move down on 2000 is roughly 10, 12%. So here is the key feature and the most important thing I can tell you during this presentation. When we had what everyone refers to currently as the financial crisis of 2008, gold retracted 30%. This time, it's not over. I'm not saying we're at the bottom. I think we're close. I think, many of my group will tell you 1750, it's not going 30%. I'll put my reputation on that. So we have a major, major problem financially, much worse than 2008. And yet gold is holding up far better. Maybe it's only sold off a third as badly as it did 2008. Now, that is my key point. That's why I'm asked to be the keynote. And you can argue with me or not. You want my analysis, that's it. We'll look at silver in a minute, but that's it. Now, why? Because we have a food problem. We have an oil and gas and diesel problem. We have a war. We have political instability. We have tyrannical governments that are closing down bank accounts for innocent people. Folks, I don't want to sound like Mr. Doom, but we are in trying times. And yet gold, in my view, is doing kind of a fake out. We gold bugs expect it to react immediately. We expect it to protect us, and as it should. But yet we're really, in my view, seeing it react as a better frame of reference than we saw in 2008, because we are in more troubling times. So yes, we're below the 50-day moving average, and yes, we are below the 200-day moving average, and yes, there's more work to do. And David, are you sure that we're nearing the bottom? The answer is yes. I'm just not sure on the time. Will it take 2 weeks to get out of this, or 2 months, or it won't take 2 years? My best guess is the summer doldrums will probably have some more suffering of maybe 2 or 3 months. But I thought a great deal about this presentation and what I wanted to do for everyone. And remember now, so if we go from the 1,050 to 700, it caught back up pretty rapidly. Remember, gold was the first to recover, and it recovered quickly, and so did the gold stocks. Silver got beat up more. I'll show you in a second. And it also recovered substantially. So gold went from that 700 all the way up to 1950 or so. So it more than doubled after people realized the place to go was with gold and gold-related investments. So silver's story is even more interesting in that same time frame. And what I'll show you here for silver is I'll try to match pretty much the same thing I did for gold so we get the proper perspective. And let me annotate here. So we go from here. Whoops. Sorry about that. We'll get it here. I do this fairly often. By the way, this is the kind of work I do for the paid subscribers. I do this type of stuff for them. So if we look at silver, silver had a nice run all the way up to 21. I remember it well. I called that top, by the way, for those that are interested. And we went down to, I'll call it 9, even though it was an 8 handle, I believe, but I'm going to call it 9. So we lost 50% or more than 50% in that move. But look at this. Gold doubled roughly from the bottom of the financial crisis. But silver went from, we'll call it 9 to about 50. So it went up 500%. So it did far better than gold as far as a percentage gain. And then it topped here at the end of April 2011. By the way, I called that top as well. I called both that top and that top. Looking back, I wish I would have told everyone to sell everything and wait for all these years. I'm laughing. It's not funny. But I did call the top and I did take profits, but not everything. And it worked out well for our subscribership. So let's go back and look at where we are on the silver market right now and get a feel like I just showed you in the gold market. And I believe, again, that this is probably the most important part of this lecture to get a feel for what has happened. So we go on our annotations here to take a quick look. That silver peaked out, I'm going to call it 28 right there. This is recent. I'm only looking at this year. I know I got 3 years up here. And then, of course, where are we now? We're at 2050. And there isn't much support in here, by the way. Could silver get down into 18 level where it's got tons of support? The answer is yes. Will it? I think it will, actually. So I'm nibbling here. I'm not putting in a big purchase. We get into this range, I'll probably load up. So we saw what silver did from 21 down to about 9. So it got cut in half more than 50%. So if we take 27 and round it out, 27 and a half, or maybe move this up if I can. I mean, the top, I actually say 28 is a better number, but you can pick your own. This is an art, not a science. So if silver got cut in half, we'd be looking at $14 silver if it matched what we saw in the 2008 financial crisis. We're not seeing that. Just like gold, silver is selling off harder than gold did, but less percentage-wise than it did last time. Why? Same reasons. We've got a war, we've got food issues, we've got all that stuff I already stated. So right now, that is the key takeaway, that gold and silver are not performing as we wish, but they are performing, in my studied view, as we would expect. Why does gold and silver sell off when everything else is selling off? The answer is there's so much leverage in the system. There is so much going on with the fund managers, the money managers, pension funds, insurance companies, and everybody's looking for yield because there isn't any in what's called the safest investment, which is the bond market. And the bond market is having issues as well because interest rates are being pushed higher and not that much. 50 basis points, really 0.5% is nothing relative to historic standards, but relative to these very trying times, it's significant. So there really isn't many places to hide. For a very long time in recent days, meaning the last few years, a huge amount of money has gone into the crypto space, and the cryptos are getting decimated. If you think gold and silver aren't looking good, take a look at what's going on in the top cryptos, Bitcoin, Ethereum, Doge, XRP. All these are down like 60%, and so silver is off what? Did I give the percentage? It's significant, but it's a lot less than the cryptos are. Stock market on aggregate is only off 12% or so. And that's true if you hold like an ETF. I won't deny a fact, but I think the point of demarcation is coming this summer, which means we'll see further weakness in the general equity markets, and we will see a bottom hit in the precious metals. One of the key facts that isn't really talked about too often is oil. Oil is the key. And oil prices are high, and unfortunately are going to move higher. The problem with oil is several fold. One is that there is a lot more tightening in the main producers than the average person is really aware of. Behind me here is Twilight in the Desert by Matt Simmons. That book is probably at least a decade old. But what it outlines is that the reserves that are purportedly available due to the Middle East really is an exaggeration. There's other books that come to the same conclusion. And the refining of oil is an interesting situation because the United States, on the most part, has light sweet, which is like the caviar of the oil industry, whereas most oil around the world is heavy, might be considered something, along caviar to tuna fish. So we export some of our light sweet and import some of the heavier oil. So why would you do that? If you got the best, why would you export? And the answer is because of refineries. Refineries that we have around most of the coastlines of the United States are set up and maintained to do heavier grade oil than what we get primarily out of the United States. So right now there's a diesel problem, and this is going to affect everyone on several levels. The first level is that it transports our food, and also natural gas is the prime ingredient as fertilizer to produce food. So people might think, well, David, that's concerning, but I am not that worried about it because I drive a gasoline car or I have an electric vehicle. On the gasoline side, let me remind everyone that the gasoline that comes to your pump at your local filling station is driven by a truck that requires diesel to transport that gasoline there. So if there is the diesel issues that I'm outlining here, and I'm going from mainstream sources here, which I have a somewhat lack of trust of some of it. Regardless, we will see it backfire into the gasoline market for the reason I just stated. It's transported using diesel equipment. It's supposed to hit the East Coast first, the East Coast of the United States. Of course, we'll be watching for that carefully. And we will have to basically tighten our belts. There's this my favorite word, interesting times ahead. So I want to summarize in the last couple of minutes here a few things. Number one, the most important, I think, during these times of trying times, which is basically a cycle. If you've watched my movie, and it's not my movie, watch the movie, the Four Horsemen film that's available on my website on the About page, or it's free on the internet. You'll know that the rise and fall of empires is something that's cyclical. So we are there. And we will have a new system that emerges. Whether it'll be favorable to the people or not remains to be determined. I'm optimistic enough to think that it will. I really do. So we need to basically take more responsibility and probably be a bit more frugal and use our investing wherewithal to not only protect our capital, which means gold and silver and miners, but also what we can do with that wealth going forward, because some will have more than enough and you can sit on it, or you can have a more luxurious lifestyle, or you can ask yourself the question, what would be the most benefit or win-win situation for me and others with this capital I've accumulated when we start the reset? In other words, capitalism at its finest, which we're really not in, is entrepreneurship, where you discover something or produce something or think of something or improve something that benefits your fellow man or woman. And it benefits you at the same time. This is the true market capitalism, free market enterprises that have been so successful of making more people sustainably, let's say, well off than any other known to mankind. So, Matt, I'm going to head and sign off there. My very best to the Metals Investment Forum people. I will be available for Q&A in the other sections of the MIF. And if you have any questions on this lecture and you're in one of the mining wrap-ups that I'll be doing later, go ahead and hold off and give me those questions at that time. I'll be happy to answer them. Thank you very much.